Naked call writing is a really great way to make some income. And in this video, we're going to cover everything you need to know about writing a naked call to get started to make some income. And just make sure you hit that subscribe button and that notification bell so that you know exactly when new content is released. Also, let us know any questions and thoughts below, and if there's any video topics you want us to cover. And as always, we take your comments into consideration. So let's assume you have a basic understanding of options in regards to calls and puts. So we're going to look at another way that you can profit in the options market. Now, so writing a naked call, it's not a very conservative, bearish trading strategy. It's really more for the experienced trader who fully expects the stock to decline during the life of the options contract. Now, there's a lot more complex option strategies out there. This one, I think, is pretty straightforward if you understand the basics. So what does it mean by writing a naked call? When you write a naked call, all this means is that you're selling a call option on an underlying security like a stock without owning it. So this means that you have a bearish outlook on whatever the underlying stock is, and you're looking to keep the premium that's paid as a profit. Remember, a call buyer is bullish on the market. So for that premium, you are going to give the buyer of this contract the right to buy the asset, so let's say stock, at whatever strike price they have chosen when they bought the contract. So let's say you believe that stock XYZ is going to stay pretty flat or it's going to decline over the next few months or so. You could sell an out-of-the-money call option on XYZ. So for example, let's say it's a strike price of $50. Current market price is $45 right now, and an expiration date 1 month from now. But the buyer of that call option, they believe that this stock is going to rise. So they hope they're going to make some profits. So if at expiration, the stock is trading below $50, that option is going to expire out of the money. You get to keep that premium. That's your profit. If that stock is trading at or above $50, you run the risk of that contract being assigned, and you need to buy the stock at the market price and sell it at the strike price of $50. Remember, they have the right, but they don't have to do anything. But as a seller, you must make that transaction if they want you to. So the risk that you have as the writer of the naked call is that underlying stock could jump huge. And if that contract is exercised, your losses could be astronomical. So how much money can you make? Well, the premium you receive is the maximum profit you can make, right? So like all options trades, there's going to be risks involved. If that stock rallies sharply, you could be assigned the stock, and you have to buy it at the price that may far exceed the strike price that the call buyer has the right to buy it at. Let's use that previous example of XYZ, and the premium the call buyer paid is $3 a share or $300 for the contract. That $300 goes into your trading account. So remember, this is out of the money, so there's really no value in the contract right now, just time. So your break-even price is the strike price of $50 plus the premium per share of $3, which is $53. So as we wait for expiration date, time decay works in our favor. So that stock closes below the strike price, which means out of the money, and that contract is left to expire. Your profit, $300. This is exactly what you want to see happen. If it closes at the money, well, there's a greater chance of the obligation needing to be met, but really only about 7% of all contracts get exercised. So if the contract expired, it's worthless, right? You keep that $300. If the call buyer uses a sell to close order and the current premium is 50 cents, well, you would net $300 minus $50 equals $250. Remember, the current premium is 50 cents, but we're talking about 100 shares. It's $50. The most a seller of a naked call option can make is the amount of money they made with the premium. You can't make more than that, but you can certainly make less. So according to most traders of options, selling naked calls, very risky way to trade. Because in theory, stock prices have unlimited upside potential. So if you sell naked calls on an index or a commodity contract, well, the upside is capped somewhat, right? So you don't have that same risk factor. Now, all trading involves risk. So the biggest risk that you have when you write naked calls is having to buy that stock at the current market price and then selling it to the call buyer at the strike price. So let's say you sold a call. It's a strike price of $50. But there's a good news event. That stock went to $75 and that call buyer exercises the option. So now what do you have to do? You got to purchase that stock at the market price of $75. Then you have to sell it to the call buyer for their strike price of $50. How much do you lose? The $75, that's the stock price, minus a strike price of $50. You lose $25 a share, or $2,500. Now you also received an option premium. That's going to reduce your losses, a little bit. You have to accept that the risk of loss could be virtually unlimited. You have to accept it. So we need margin, right? So using a margin account, the following information, this one is going to come from our favorite place to trade. It's called Tastyworks. You can read it here. The margin requirement for an uncovered call is the greatest of the following calculations times the number of contracts, okay, times the multiplier. That's the 100. 20% of the underlying price minus the out of the money amount plus the option premium, or 10% of the underlying price plus the premium, or $2.50 times the 100, of course. Now the premium that you get from the sale, that can be applied to meet the initial margin requirements. So there's another example right there for you. So on this example here, the requirement that you're going to have is $1,150, but you also have the premium of $150. So the buying power that you need for this trade would be $1,000. When markets are flat or the stock price is on the decline, experienced call sellers can make a really good income. Time decay, that's the time between opening the contract and the expiration date. That can work in your favor. The less the stock moves against you during this period, the better. The closer the expiration date gets, the less money the buyer will be able to sell to close the position for. That's going to save you money as well. You keep more of the premium. On the flip side, though, you will have, in theory, unlimited loss potential, with the reward being limited to the premium that you get. But there's good news. If you skip the low volume cheap stocks, nobody really trades. It's probably a better way to go. These are pretty volatile. They can whip up and down at a pretty frantic pace. So you want to stick with underlyings. Like ETFs are good. Index options are good. And that's where you're involved in a basket of underlying instruments. So because of the basket of underlying instruments, the volatility is not as harsh as if you're just trading individual stocks. You want to use far out of the money instruments, right? OTM. And they must make a big positive move to have any intrinsic value. So again, we want time decay to work in our favor. So if you have sell options that have far away expiration dates, you're giving too much time for the underlying asset to make its move. Right? So the closer the expiration, the greater effective time decay. And it's a risky way to trade, right? But it can be profitable if done correctly, and a lot of people do it. You have to be prepared for the possibility of losses, and those losses could be substantial. And that depends on whatever the asset is that's underneath the options contract. The margin requirements can be a little bit higher just because there's bigger risks involved. And at NetPicks, be honest, we're not fans of selling naked calls. There are other ways to profit when trading options that can limit your risk. And there's a free guide. It's an 8-minute options cookbook, we call it. And you get a peek into how we trade the options market. All right, so thanks for watching the video, and we'll see you in the next one.